Hey everybody, Tim Knight. It is Tuesday afternoon, and I thought for my sake and yours, I would just help kind of clear the air by going through some index charts and kind of talking about them. Of course, the date is through end of day Tuesday. This is October 26th, I think. No, 25th. It's sort of funny that 9 trading days could rattle me so bad. What I'm referring to is, of course, is the morning of October 13th, I believe it was, the day that will live in infamy, when the CPI came out and we cracked 3,500, only to, we tagged 3,500, only to explode hundreds of points higher on the ES, thousands of points on the Dow. Pretty sickening stuff. And in the meantime, if you just judge by the S&P, the percentage rise hasn't been that huge, but individual stocks have moved up tremendously. And it's been a real turd in the punch bowl. And in my market confidence, and it's just been a psychological mess. And that's been obvious by me retreating my positions from basically pedal to the metal, like, 37 positions and, flags fluttering behind me, to a mere 18, 51% cash, and me just sort of like sitting in a corner swaying back and forth. And this is all in the context of options that don't expire till next year. So the thing that compelled me to do this, of course, and it could be a one-day wonder, it could be earnings blowouts for the rest of the week, who knows. But if you look at Alphabet, if you look at Microsoft, if you look at Texas Instruments, there's definitely some shaking going on underneath the surface. And I also believe that thematically, the powers that be are definitely keeping things propped up for the election. And I think that we're going to see the atmosphere change after the election, no matter who wins or whatever. But that's 2 weeks away. Let's talk about now. And all I'm going to do, I'm talking about one and only one ETF, because it's the only ETF in which I have a position. And I'm going to walk through, 10 big indexes I follow and just have a few words about each. The ETF is XLV. This is healthcare. And I bring it up just because, this is not a dynamo. This is not some ultra biotech thing. It's a fairly placid mover, and it's pretty much built on stocks that do nothing but go up. But it's had a couple of pretty big bearish setups. You've got the broken trend line. You've got this marvelous diamond pattern. And as a third bit, you've got an approach to a perfect tag, like to the penny, of that broken trend line. So this is, I think, my favorite ETF right now with respect to bearish setup. And that's that. So my 18 positions is this one, and then 17 individual ones. And I'm self-flagellating now because, as I mentioned offhandedly in comments, some of my very favorite charts, some of the things that I think are just dynamite charts and have incredible potential, I dumped. It's like I dumped a girlfriend who's a 10 just because I ate a bad hot dog or something, just stupid reasons. So I just have been so freaked out by the persistent, robust strength of this market that I've even taken my very favorite charts and shot them in the head. It's a real damn shame. And of course, I'm doubting myself so hard. It's like, well, I'll get back in tomorrow and then they'll go against me again. So not in a great space right now, I gotta tell you. But the charts speak of themselves. So let's just go through those. The Dow Jones Composite. And I'm just going to have a few words about each of these. On the whole, the patterns are very, very similar. Long-term, bearish, and very short-term, they've been quite bullish. But medium-term is what I'm focused on, which is they have approached some very interesting points of resistance or exhaustion. So the Dow Jones Composite, in this instance, we're getting right up close to this gap. Another reason I'm screaming at myself is because I've got an itchy feeling that Wednesday could be the first good down day in a while, and I'm really not prepared for it. I'm only half positioned. But there is the gap right there on the composite. My nightmare, of course, has been the June 15 to August 15 repetition. And I don't know if a mere 9 days will satisfy this bounce. It might. But that's kind of the assumption here. I'll also say my pissy post about zero hedge is, it's just sort of a lashing back at the preponderance of incredibly bullish articles all over the place right now. If you need 100 reasons to buy the market, the media will happily provide them, even the formerly bearish zero hedge. Here's the NASDAQ composite, which, as we zoom in, we got very, very close to this line. Now, keep in mind, these are cash markets. These do not reflect any of the drops we saw Tuesday afternoon at all. So unless something crazy happens between now and tomorrow morning, these will almost certainly turn south instantly at the open. Now, here's the one that really upsets me. This is the Dow Industrial. As you can see, long term, we are sky high. But we zoom in and look at this. Let's get in nice and tight. Look at this gap. 31159, I'm sorry, I can't even read digits, I'm so screwed up. 32159.49. That's the gap between the 12th and the 13th. Look how close we got, and most important, look at this line right here. This is the trend line anchored to the COVID bottom. Here. This is the break. Here's the hard fall, and we snapped below it, got beneath it, fell hard. There's the bottom. Interestingly, we had a bottom on the, well, no, it's not interesting at all. It's obvious. The 13th of October, that was the big CPI bottom with this enormous candle. And we have blown from 28.6 almost to 32,000. So like 3,500 points, whatever that is. But look where it is versus the trend line. It would make all the sense in the world for this thing just to be screw you and fall away from it. And there's the gap to augment that. NASDAQ 100. Everything above that, let's make it a red line. Everything above that red line constituting pretty, it's not a terrible top. It's give it a B+. It's not the cleanest in the world. S&P 100. There's my, once again, this business here and certainly this business here, make it ugly. These are not super clean tops, but they're not bad. B to B+. This one probably is my least favorite because it's very hard to read. This is the Russell. We had a double bottom here. So way back on June 16, it hit that fib, repeated it here. So it's clearly got strength in this location, but not an appealing chart to me at all. This is the semiconductor index. Take note of this gap. And now with what Texas Instruments is doing right now, it seems to me we won't get even within spitting distance of that gap. Maybe the peak was already had on Tuesday because Texas Instruments, last time I looked, was down pretty hard. S&P 500. This is all about these two Fibonacci's. There's this one here, and then the shorter term one here. And we actually have a 1-2 punch. Look at these, how close they are. We've got the one anchored to 2020, then we've got the one anchored to 2009. And they're both just about the same spot. We're above them both, but this confluence here, this is 38.15, this is 38.38. We've got a little above them both, but if we slump beneath that, I think it illustrates the potency of that 1-2 punch of those two different time frames. The transports, as with the Dow, quite interesting. Look at the gap. Look how close we got with that dashed line. And the last one, we'll keep it at the 10-minute mark here. The utilities, less interesting, but you know what? Let's just add a horizontal just to highlight prospectively. It actually is pretty damn good, to tell you the truth. It's better than some of the other charts we've seen. So that kind of highlights the exhaustion point there. So long story short, if we go plunging in the morning, I will be searching the kitchen for knives to plunge into myself. But anyway, I want to try to be of aid to you for what it's worth. So I hope some of these words and charts are helpful.